Welcome everyone to our June webinar, quite topical at the end of the financial year. It's a time of year where accountants and advisors are all busy, but also exciting from a strategic perspective to think about some of the things that are front of mind at this time of year and some of the opportunities that we can make sure that our clients are aware of and making the most of. I can see there's quite a large number of attendees today. Some of you may be new, so perhaps just a quick introduction. I'm Josh. I'm Chief Operating Officer at SuperGuardian, and we've got Tim with us again this month, as we do every month. And for those of you who haven't been joining haven't joined some of our more recent webinars, Tim has gone from a consulting role to an employee role back to a consulting role, and so Tim joins us today. He is employed by Smarter SMSF, but continues to support us with our advisor education, and it's great to have you with us again, Tim.
Good to be joining you, Josh. Always good to get in here and have a chat to your audience and yourself as well, and particularly this time of year when there's so much stuff going on in the SMSF space. I remember as I was prepping for this, it was like, well, is there really anything to talk about in the SMSF space? And you just have to go to the ATO page, and they have a what's new and what's coming up, and the amount of consultation stuff that's occurring and the number of changes that we're going to see over the coming months and clarification on matters is pretty significant. So we never run out of things to talk about.
It sort of felt like a bit of a sigh of relief when there wasn't too much in the federal budget, but notwithstanding, I think that's because there's so many things already in the pipeline that that we're seeing go through, and that in many respects create complexities, but also opportunities.
Yeah, correct. All right.
So today, feel free to jump in and make suggestions of areas that we cover that are of particular relevance that you might want to hone in a bit more on, or ask questions. We're more than happy to make it interactive. Just jump in the Q&A box there, and feel free to put anything in. But basically, some of the key things we want to cover off on today, up on the screen. We did just miss the disclaimer. I might just go back to that quickly.
Yeah, fair enough.
So just for context, SuperGuardian are an administration practice. We provide traditional accounting services, but more so, we're in the business of providing up-to-date information, financial information and education that will help advisors and accountants and their clients to make better informed decisions. Therefore, what we're sharing with you today isn't personal advice. We don't provide personal advice, but we do work with advisors who do that. So what we'll be talking about today is more around the strategies that you can do and those things that you can do with super and in an SMSF. If you would like to consider what you should do, then I strongly suggest that you chat with an advisor and get personal advice for that. There's our disclaimer. So what we'll look to cover off on are some of the key things at this time of year around contributions and pensions. Some anomalies this year, both in terms of how indexation applies to the amount that our clients can hold in pension phase, but also to the total super balance, and then how that impacts on the amount that our clients can contribute into super, but also in terms of the timing, when you might look to commence a pension, making sure that the minimum pensions are taken well in advance, and some of the other changes that are occurring around the residency rules.
Yeah.
So without further ado on that, might hand over to Tim to touch on some of the rates and thresholds that are changing.
No worries. Look, thanks, Josh. And I think it's important to identify, and I can occasionally throw names out there that might be a little bit incorrect, but I think his name's Stephen Jones. Is that the Minister for Superannuation, Stephen Jones? Yeah. Yesterday he released, or he did a press release, a media release, and it was as a sort of a flow on from the quality of advice review. And one of the key things that he highlighted, particularly around superannuation, was the importance of access to advice and making advice affordable for a lot of people, but also around the quality of information. And I think that's where the key issue around good quality administration and up-to-date reporting is pretty vital, particularly when we are looking at retirement income strategies and the transfer balance cap. There's nothing more critical, and we've discussed this plenty of times, nothing more critical than ensuring that a member's total superannuation balance is correct, because it could be the difference between accessing certain strategies that we'll touch on, but it can also be the difference between making contributions or making different sizes of contributions from a non-concessional point of view. And probably one of the key things when we talk about the acceptance rules around contributions and that as well, is that the onus now since 1 July last year is not on the trustees. The trustees just have to pretty simply say, how old are you? Right now they're asking that question to themselves, obviously, in the SMSF space, but they have to ask, how old are you? And then that will determine whether there's eligibility to contribute. But then the Tax Act will determine the tax ramifications of how much you contribute. So all of the concessions are spelled out in the Tax Act. Trustees, from a SIS point of view, are just looking at your age. So it's important to have timely accounting information to be able to ensure that you get your appropriate levels of contributions. And what we see often at this time of year, and I wonder what will happen with the industry this particular June, but normally we see a flurry of contributions now because with a mid-May lodgement date, a lot of people are only getting certainty on their total superannuation balance now. And so this is normally the time that they make those contributions. But given that we've got indexation of the general transfer balance cap, sort of as you kind of alluded to as being a bit unusual this year, will we see that flurry in June, or will people hold off to July? Certainly those with higher balances will hold off because it'll give them access. So,
not to mention too the transfer balance account reporting.
Yeah.
Timing this year, is another good reason to have your accounts up to date.
Correct.
And certainly not wait until they're finalised next May lodgement.
Correct. And we'll go through that through the presentation as well. So as you said, let's talk about this indexation element, because there's a couple of things that I wanted to highlight here, because this information's been available since February. We get the CPI figures first. We'll get excited, things like general transfer balance cap, and then we wait a little bit longer and we get the AWOTI figures, and then we get disheartened because the contribution caps don't index at the same time, because all these things aren't necessarily linked, which has always been the quandary of superannuation, linking things to different indexation factors. But so we know that we've got the general transfer balance cap being indexed to $1.9 million. But I wanted to highlight, I guess, a bit of a quirky cap that has been indexed for next year, and that is the maximum contribution base. Because the maximum contribution base is the amount that an employer effectively must contribute super guarantee up to. So, when you've got employees who earn more than the 62,270 per quarter, and again, appreciating that this is a smaller cohort of employees, but it's still significant enough to have a conversation about it. But the employer is only required to contribute superannuation guarantee on that 62,270. Now, super guarantee next year increases to 11%. So in a moment, I'm going to sort of highlight the coming together of multiple worlds and what problems that can create moving into the next year. So in some instances, individuals will have missed the boat with regards to the issues associated with this, but they can then act for later on or earlier on, say the second quarter of the year, as to how they can deal with the situation.
So should we just maybe touch on that for a moment? So practically speaking, this is where the super guarantee contributions effectively may see the contributor exceeding their concessional contribution cap by virtue of the contributions, the compulsory contributions. Effectively, but there's a rule that says no need for a second employer to make those super contributions if you are going to exceed that.
Yeah, sort of. That's taking a very good simplified approach to it, and of course we need to make sure that people understand the ramifications. So yeah, you're right. The concessional cap for most of these individuals is going to be $27,500, because you'd assume that most people that are earning up and around the $250,000 a year probably have more than $500,000 in super, and so therefore they wouldn't be eligible for the carry forward concessional. But we'll put the caveat in there that they might be a late contributor to super. They might be new to the high income world, and so they might have less than 500,000, so their cap may be higher than 27,500. But if we make assumptions and look at the issue of people saying yes, they're going to have above 500,000 at the previous 30 June, and then they're subject to this maximum contribution base, what does it all mean? There's a couple of other points there about contributions post 67 that we'll get onto in a moment. What it means is that on 62,270 moving into the new year, the SG rate, so the compulsory requirement on the employer, is 11%, gives us a quarterly contribution of 6,850. Multiply that by 4, that takes you to 27,400. So that brings us $100 shy of the cap, right? So that's a fuel moment if we've got one employer and that employer sort of cuts out and doesn't have to contribute above 62,270. And of course, you can talk to your employer and say, arrange salary packaging. What else can we do to compensate the fact that you're not going to pay me super above that amount? Whether employers do that, that's obviously totally up to them. The other thing is, when you multiply 62,270 by 4, you get 249.80. Now, these two numbers, 249.80 and 27,400, they concern me because of where we're at from an indexation point of view, because 249.80 is just shy of the Div 293 threshold of $250,000. So one more year of maximum contribution base indexation, and all of a sudden the annual income puts us above $250,000. And even with it at 249,000, it means that our income plus our compulsory super is going to put us over the Div 293 threshold. So, straight away you go, is there going to be a change to Div 293, or are the government now just happy to say, right, well, based on compulsory super, we will start to collect an additional 15% tax? Doesn't seem to be in the spirit of the game, but ultimately that's where we sit. So we will soon be potentially in a situation where just the threshold alone will be above the Div 293. So will we see the indexation removed, or will we see it maybe fixed just at 250,000, or will we see an indexation of the Div 293 threshold? I wouldn't have thought that's coming. I wouldn't have thought that we're going to see 250 going back towards the 300 mark where it came from. So it just creates a bit of a quandary that people need to be mindful of. But to go back to your point, Josh, and that is that there is the capacity, and they call it the super guarantee opt-out for high income earners with multiple employers. Nice, easy title to state there. There is an opportunity, if you've got more than one employer, and you must have one employer who is contributing super guarantee, for you to apply for an exemption for your second employer or additional employers. Now,
and that's an application to the ATO.
That is an application to the ATO.
And it needs to be done by a certain time, doesn't it?
It does need to be done by a certain time, and that certain time is 60 days before the start of the quarter. Now, maths is, in a superannuation environment, never been my strong point, but I know if the quarter starts on the 1st of July, we've got far less than 60 days. So for a lot of people now, they're not going to be able to apply for the first quarter of the year to have that exemption apply. So if they've got two employers, they may very well be in excess of the caps.
So here's a practical thing, I guess, to to take away for those of us who have clients that are earning in excess of 249,000 or in excess of 62,000 per quarter, and have multiple employers, is to make sure that there's an application that's lodged prior to 60 days ahead of. So let's start looking at applications for the December quarter. To have those contributions or to have that employer exempted from paying those super contributions, and negotiate the extra amount, the
salary. That's
into
right.
The salary, of course.
And the ATO help us out, so they let us know that the 2nd of August is the lodgement date for that application for the 1 October start date. So the ATO do provide the appropriate references. But I thought that was a really interesting thing, that we look at these stats every year and all the numbers go up, and we go, oh wow, we get more if we earn a little bit more for the $500 that the ATO give back. But sometimes we don't look at the top end at what that means, and I felt that this was quite a relevant one for us to be aware of. So that's a sort of one issue to be mindful of when it comes to indexation. As we'll touch on a few of the other contribution things in a moment. The other thing, and this is going to impact a lot of clients, I suspect, is the PCG 2016-5, so our safe harbour LRBA rules. Each year, if you apply the requirements of PCG 2016-5, which of course for related party loans, it's not compulsory, but it's recommended that funds undertake this, then the interest is ultimately fixed each year based on the May standard variable housing loan for investors rate as published by the RBA. Now, this was published last week, and the rate for next year for real property is jumping to 8.85%. Now, that's pretty significant because, one, it's always hovered in that sort of between 5 and 6%. It got up to roughly, say, 5.9 at its peak. So to jump to 8.85 means that from a principal and interest repayment requirement on monthly terms, which is what the requirement of PCG 2016-5 are, means that our funds, really need to make sure they've got the cash flow capacity to meet their LRBA repayment requirements. The other key thing of that PCG is that the maximum term for real property is 15 years. Now, what we do know is that through COVID, funds could apply for repayment relief so long as they factored in those repayments under the same loan term. So we couldn't increase the number of years, it had to stay as 15, but we had to ultimately just increase the payments. So now we might have clients in situations where they've got increased payments because of COVID shortfalls, and increased payments because of this requirement to up the interest rate. So, it's a really significant jump. And the CPI factors that we're seeing probably suggest that we're not seeing these numbers take a downward spiral for potentially a couple of years. So it's one that we need to ensure that our clients are documenting and are making changes to their payments from July. So, from an administrative point of view, I think it's one they really need to get on and talk to their clients now.
Yeah, and managing liquidity is a big part of that. So, it may impact on the investment strategy review for this coming year.
Yep.
In terms of the percentage of the fund that you want to keep available as cash, or ensure that you have the cash flow to support those additional costs for the fund.
Yeah. So again, one of the key issues that people need to be mindful of. So look, let's have a look at the contribution issues, and when I say issues, good and bad, in regards to not just the pre-30 June planning requirements, but also our post-30 June strategic requirements and things as well. And that I have like a favourite slide when it comes to contributions. You've certainly seen this one before, as has anyone that's been to any of my contribution presentations in the past. I like to identify all of the various strategies that are available from a contribution point of view. Now, to take this slide one step further, is all of these strategies are what I would say not not asset tested so much, but they're all certainly subject to some levels of control or some notice requirements or deeming or whatever you want to call it. They're all sort of means tested, including, like we've just gone through, super guarantee. So the simplest of all strategies, which is your employer contributes on your behalf, is still means tested, and we've just seen that with the maximum contribution base. So when we start to look at old school strategies such as recontribution strategies, bring forward, all those sorts of things that carry forward unused concessional, we need to be looking backwards to determine what is our total superannuation balance, to work out whether we're eligible to contribute. And this is why we made the point before about, are people flurrying to contribute now, or are they waiting to the point where the general transfer balance cap is 1.9, which is next year, which means they've got more potential contribution space. So, it's that double quandary of, should we put it in now because contributions haven't indexed, or should we wait because we might be able to put more in under the bring forward, particularly for those higher account balance clients? So it's good to go through this list, not necessarily as a checklist with each and every client, but with each of your clients, you should be able to go through this list and go, right, which of these strategies should we be identifying with regards to what they might qualify for this year? And then once you've worked through that, then work out the means testing requirements, the notice requirements, and all the other elements associated with it. So I'm going to focus on two of these primarily because they're probably the two most critical and most commonly used ones. I will, for a moment, pause and talk about contribution reserving. So whilst it's not necessarily one that is used commonly, it's still one that is talked about in June every year, and that is having the capacity to bring forward. And I shouldn't confuse that with non-concessionals, but to use next year's cap by making a contribution now and claiming a larger personal tax deduction, and then allocating that contribution to next year for contribution cap purposes.
So this is really relevant to clients that might have a larger disproportionate taxable income this year. Correct. Because of the sale of an asset or something like that.
Yep, absolutely.
The ability to bring forward, the ability to contribute now.
Yep.
And have it counted towards next year's cap. And claim the personal tax deduction now.
Yeah,
and is attractive.
It is attractive, but it's hazardous in that people need to understand that from your point of view, Josh, you have to report the contribution now, right? So for all intents and purposes, they have an excess contribution, right? And as far as the ATO are concerned, they'll have an excess contribution. But there is the capacity through the ATO website to adjust your concessional contributions. But ultimately, if you've got clients that are looking at doing this strategy, then firstly, they want to make sure that the deed provides for it.
Yep.
Secondly, they want to make sure that they have minuted the acceptance of the contribution this year, that they have minuted the allocation of that contribution to the contribution holding account / reserve this year. And then in July, they minute the allocation of the contribution, because at a minimum, they're the four things that the tax office want to see: the deed providing for it, and then the various minutes that outline the transaction as it occurs.
Yep.
And I would also suggest that you lodge the application with the ATO immediately, so that it's on their radar, rather than waiting for the inevitable excess concessional contribution notice that will occur, because administrators must report the contribution in the year that it's received, so that it satisfies the tax requirements of the fund.
So it's worth submitting that proactively to the ATO.
Yeah.
Definitely.
Yeah.
Via their form.
Yeah.
To allocate concessional contributions.
Correct. So that's if they want to go down that contribution reserving process. I would also definitely say, as a bit of a warning, if you're trying to do it for non-concessional contributions, firstly, I would say, and I know I can't give advice, but I would say why, right? Because now that there is no work test requirement around,
and especially this year,
non-concessional contributions, the whole idea of bringing forward an amount because you're not intending to contribute it next year just seems pointless, and there is no form, and you have to go through the ATO, and ultimately I haven't seen a great deal of success in that space. Yep. With non-concessional contributions. So the bring forward amount, just so that that people have that clarity, and we highlighted it before as well. Now what we're looking at is what our balance is going to be at 30 June this year. Of course, we have to go back 12 months if we're wanting to make contributions. Now we have to go back and use our 1.7, our 1.59, and our 1.48 as our determining factors for the bring forward amount. But moving forward, these are the numbers that we're going to entertain, and that then takes us on to this one, which is really about, I like this one as a bit of a guide to say, okay, if we want to maximize our non-concessional contribution, so if we've got a client who is starting their superannuation journey now, and when I say starting the journey, I really mean like they're not in the retirement phase yet, but they're contemplating how to maximize the amount they want to put in the super. If we say, what year is the pinnacle contribution year? Well, obviously our 75th year, so the year that we turn 75, if we can utilize the full bring forward amount in that year, then we get the benefit of in theory, contributing in the year that we are 75 and the year that we are 76. So, that bottom of the three charts there, or the three rows there, is the one that we're looking at if we're going to use the bring forward. So, 74, 71, 68, 65, and you can keep working backwards.
Assuming there's no legislative changes between now and then.
Assuming there's no legislative changes.
But of course, with what we know, it does make sense, and it makes a big difference planning ahead. And allows us obviously to maximise the amount up to that 1.9. Where contributions might not have been, or the balance might not have been as high to begin with in the years leading up to retirement.
And look, I always look at this table and this concept with intrigue, particularly now in light of the SIS acceptance rules from a contribution point of view, to go, is the bring forward as relevant, right? Because now that we don't have to meet a work test, we could contribute at 72, 73, 69, 7. So every year you can contribute up to the cap. And of course, that safeguards you against indexation of the cap. So if you trigger bring forward in the year before indexation, you're going to miss out on 2 years of that indexation amount. So contributing every year works in favour of avoiding the indexation trap. However, the bring forward amount might work in favour of high growth strategy, where if you make 110 and then the next year you have a massive year from a growth point of view, from the investments of the fund, you might not be able to put in that 110 the next year. So you might actually get 2 years benefit out of doing the bring forward versus the 1 year. So it's 6 of one, half a done of the other, which is correct.
It can also be useful for pension planning. So if you're looking to maximise the tax-free and the non-concessional component of the member balance, rather than contributing each year and commencing new pensions each year, or commencing a new pension after the third year. If there's the ability to contribute it all at once and commence a pension from that amount, then that entire pension becomes tax-free from which is certainly beneficial for estate planning purposes.
And look, we have to, again, going back to the disclaimer elements of the start of the presentation, but the whole use of bring forward contributions for spouse contribution purposes and equalisation. So particularly in light of the $3 million cap, or the $3 million better targeted super concessions, as they're currently calling it. Are we looking to reduce members' balances below that $3 million, where of course they can't make non-concessional anyhow? But we often look at the recontribution strategy and the bring forward as being an individual strategy, where we kind of touch on what is our balance. It's around that general transfer balance cap, so that's going to give us a capacity to pull some out and put some back in. Whereas for the lower balance spouse, this is an opportunity to go, okay, if we've got a higher balance, and particularly if we're approaching that $3 million, is there an opportunity over a period of time, and at least you've got one cycle before the measure comes in, is there an opportunity to reduce your balance by the bring forward amount to put that into the spouse's account balance? Now, there's still the estate planning element of all that, and what it means when you pay reversionary pensions and other things. But it's certainly an area that I think we need to be mindful of. But of course, the key for this year is that last year it was $1.7 million. So given that the acceptance rules have changed, the trustees can accept those contributions. So you've got to get your numbers right, so you don't end up with an excess non-concessional contribution.
So hypothetically, so if you go to the previous slide there, Tim, if a retiree has or any superannuation has 1.7 million in their super today, and assuming no change in the market value between now and 30th of June, as of today, they can contribute nothing additional in terms of their traditional non-concessional contributions. If they were to withdraw
anything,
if they were to withdraw 20,000, that would take them. That would take, or 21,000, that would take them below the 1.68 million. And potentially from 1st of July free up the ability to contribute 330 as opposed to nothing now. So I guess that's it, with the goalposts shifting, with the limits shifting, it does open up new opportunities, and that's probably a very unique sort of specific example, but an example that demonstrates that it does open up quite a window for those around that 1.7 mark.
Which also, sorry to jump in there, Josh, which also means that if any of you have clients who haven't lodged for last year yet, it's critical that you get those returns in so the total super balance is actually representative of what they have, because otherwise you just can't make plans, or you can't make contribution plans for those that hover around that general transfer balance cap number. So it's pretty important. And
not only last year, but this year as well, in particular. So especially for funds that might have unlisted assets, or assets that are going to require some sort of a valuation that's not readily available. Make sure you get the valuations before you go relying on these limits, because a valuation of an unlisted investment, a property trust or something like that, can change substantially over the course of 12 months since the last financial statements that you might be relying on. And it's really important that if you're relying on these limits, that you're basing it on financial statements that have considered the change in the value of the assets.
Yeah, absolutely. So
otherwise, you do end up with a letter from the tax office with a very large excess non-concessional. And whilst the flow on from that is that whilst the tax liability on the large excess non-concessional is only going to be on the associated earnings, you've still got to withdraw that non-concessional. And if you've invested, you don't have to. You can pay 47%, but let's suggest that not everybody is going down that path, or not anybody is going down that path. But if you pull that excess out, then you've got to, again, ensure that you've got the liquidity to do that. And so if you've invested this money and got that growth, then you've got this double-edged sword, because you might also be realising a tax liability for the fund because of the growth, and you've held the asset for less than 12 months. So there's so many things to factor into that conversation piece. It's the measure cut, measure 3 times, cut once approach. Getting a slight variation on values or the timing of contributions here can make a big difference. It's really important to get the process right.
Correct.
Otherwise you end up with money where you didn't expect it to be, or liquidity issues, or larger tax bills. So it is really important to get that right.
Absolutely. So just I guess we've all talked about the bring forward a lot in our lives and non-concessional, but it's still, I think, now rife for problems because of the changes to the acceptance rules. So because there's greater flexibility now for trustees to accept money, it just leads into the situation where it's easier for us to make what we consider a genuine mistake, but the tax office don't. They don't consider it a genuine mistake. The tax office suggests you should know as trustees what the rules are. And so the fact that you got it wrong, whether it be by your own admission or by the fact that you followed someone else's advice, is irrelevant largely, and they're unlikely to reverse or allow you to reverse the transaction. So certainly one to be mindful of there.
Conversely, of course, the benefits of getting it right are significant. Obviously, being able to have a large amount of your wealth in the super environment, maximising that, and maximising the allocation across the different members in the fund are all very useful strategies for tax saving and estate planning. In particular.
Correct. So let's go through an example for personal deductible contributions, and I've used a client by the name of Andrew here just because I like to put names to people when I'm talking about scenarios, and in this situation we've got our new personal deductible contribution rules. Right now, this is significant because it again has flow-on ramifications potentially with our non-concessional contribution strategy. So we go through the non-concessional strategy first, and then we move into this from a strategic point of view. So for our, from the 1st of July, if you are 67 to 75, then you don't need to meet the work test to claim a tax deduction for any contribution made up until your 67th birthday, right? So during this year, if you made the contribution before the 67th birthday, great, claim a tax deduction if you've got the income to offset, that being one of the caveats there. However, any contribution made from the day of your 77th birthday up until 28 days following the end of the month in which you turn 75, right? Any contribution made in that period is subject to the work test. Right. So given that it's subject to the work test, then you must ensure from an individual point of view that during the financial year that you've met that work test. Now, this is one of the significant changes because previously you had to meet the work test before you could contribute from an acceptance point of view. From a tax office point of view, you just have to meet the work test during the year to be eligible to be able to claim for that period. So if you don't meet the work test, then it doesn't mean you can't accept the contributions because the acceptance rules say member contributions are acceptable up until 28 days following the end of the month in which you turn 75. So failing the work test doesn't result in that contribution not being accepted. It results in that contribution being a non-concessional contribution. So when you factor that in to other strategies, it can be hugely problematic if you are over 67 years of age and are looking to claim a personal tax deduction based on having other, let's call it passive income, to try and offset with the deduction. So that's one of the key issues here, is that you've got to meet that work test requirement. Now, of course, because this is all built into the Tax Act, then if you're wanting to claim that you're entitled to a deduction, then you've probably got to be showing that working income in your tax return, which is going to be monitored far more closely by the ATO versus the old rules where the trustee just had to be satisfied that you'd met the work test. And largely, probably people got that wrong. Maybe it's too strong a word, but people were probably a little bit more flexible in regards to how that worked. But what I want to highlight is that if you make that personal contribution and you're expecting it to be a concessional contribution, and then you don't meet the work test, then that tax deduction is going to be denied, right? And therefore the amounts are going to be treated as non-concessional. The flow on of that is that it can't be rejected by the fund, okay? But then the further flow on from that is that, okay, it might be refunded through the ATO if it's an excess non-concessional, but you also might have triggered the bring forward at the wrong time, right? So let's say you and I have just gone through this whole thing with people about maybe don't use the bring forward this year because of the general transfer balance cap. So you, Josh, go and contribute, although you're not 67, so you're a bad example, right? But you do hide it very well. Let's say we've got a 67-year-old Andrew who makes $110,000 contribution this year, is over 67 years of age, makes a $27,500 concessional contribution, lodges their notice of intention to claim a tax deduction. We record it as a concessional contribution, and then the tax office deny it. Right? The tax office deny it. What have we got there? Oh, And by the way, in the time subsequent to that, we've then gone and made $330,000 in July next year because we've got less than $1.68 million. What have we done? We've triggered the bring forward this year. And by triggering the bring forward this year, it means that next year we're going to be in excess by what, 110 roughly $1,000, whatever the actual number is going to be. So it is a huge issue if we get those notice requirements wrong. And to take that a step further is because of this whole superannuation life cycle thing that I often speak about, having been blown up by all these contribution rule changes, is that there's far more sort of strategic planning around contributing and starting pensions at the same time. And of course, when you start a pension, you fix that interest in. And so if Andrew made $110,000 and 27.5 and started a pension, right, well, then that would lock in X tax-free and X taxable, then gets the deduction denied. We can't vary that notice because he's commenced a pension. And so one of the key things is that we have to make sure at this time of year, particularly where everyone's looking at 1 June pensions where they don't have to pay a minimum, or 1 July pensions where they've got a new general transfer balance cap, that we get our notice of intention to claim a tax deduction in before we commence that pension, and we acknowledge it, right? And I think that's a key thing that I know from a template point of view. Often the templates will have the deduction amount and the acknowledgement at the bottom, and I think that's pretty critical, because if you look at APRA funds, right, the tax office say that you must acknowledge that, and you must acknowledge that, and then you must also report it to the ATO. So APRA funds are under a bigger regime than us, but in the self-managed super fund space, we must at least make sure that we are acknowledging that notice, and from a timing point of view, it can be hugely problematic.
So there's probably a couple of practical takeaways there for advisors who are listening in terms of making sure that the notice to elect for the contributions to be treated as deductible contributions is completed before the pension commences.
Yep.
That's something we check for all of our clients before we commence a pension. But making sure that has been completed, and also for any advice around the bring forward contributions, non-concessional contributions. I think often we might sit there and think or ask the question around what non-concessional contributions have been made in the past 3 years.
Yeah.
But perhaps just going an extra step and looking at other contributions that might not be intended to be non-concessional contributions, that may end up as non-concessional contributions, is probably a good safety check before recommending that clients contribute the full bring forward.
Yeah, correct. And so I come back to my contribution strategies page and the means testing concept, and that is that whichever strategy you're looking at, you need to work out what are the means testing around that, but you also need to appreciate any other contributions at the time and merge all of those means tests together to see if you satisfy the requirement. But certainly the notice point of view is a key one that we need to be critical on, so to be aware of.
I love the fact that we've just spent 45 minutes talking about predominantly contributions and the impact of indexation. I think a lot of us actually think more commonly of indexation impacting pensions and the transfer balance cap, the general transfer balance cap. But it is really interesting to actually think about the impact on contributions, because it's quite significant.
Yeah, and I mean, let's also look at that from a different angle and say that contribution strategies affect more clients than pension strategies, albeit that every client should be affected by pension strategies. But you could argue every client's affected by contribution strategies, but the life cycle of contributions is longer than the life cycle of pensions for the majority of people. And yes, the two factors, which really are the general transfer balance cap and then the minimum pension factors, are really all that dictate what you've got to do in the pension environment. But then there are strategic decisions around that as well. And so one of those strategic decisions that needs to be made, and again, this is one that I would be mindful of when discussing with clients, is the fact that this year we still have our temporary 50% minimum pension reduction, and we're moving into the new year where that reduction has diminished, and so we have to change our thought process from the 1st of July comparative to what we have to do for this year. But for this year, you sort of take a three-pronged approach, because for a lot of clients, they take more than the minimum. So the first thing that we have to do is we've got to make sure that we've satisfied our minimum pension obligation. So from a satisfying the pension standard point of view, and if we've got multiple pensions, ensuring that we satisfy that requirement for all of them. So that's first and foremost. So if it's one bank account and one direct debit that comes out to the client each year, ensuring that you are splitting the benefits across their pension accounts to make sure they meet that minimum requirement. Then after that, it becomes, and don't take number 2 and number 3 as the order of recommendation from what we're suggesting here, but it's more about the other considerations. And this is almost a preemptive planning for next year, because this should have been done at 1 July this year for anybody contemplating drawing more than the minimum. And that is, what or where are you going to take any excess payments? So anything in excess of the minimum, where are you going to draw that down from? Now, there's basically 3 options. One is you're not going to take any further action. It's just all going to come out of the pension account. And I suspect for a lot of clients who are nowhere near the general transfer balance cap and aren't going to be making further contributions, then that's quite a satisfactory strategy. Just leave it, keep life as simple, the old KISS approach, keep it simple, then there's no problems with it. Alternatively, we can look and say, okay, if we've got accumulation interest, so if we have triggered that general transfer balance cap element, we can look to take the benefit out of the accumulation interest, right? Which doesn't require necessarily any adjustments to the pension. It certainly doesn't require any more reporting to the pension, but it's something that from an administrative point of view, you want to know, Josh, before it occurs, so that you can correctly allocate any amounts from the right member's interest. The other benefit of that is it probably gives the fund a better exempt current pension income deduction at the end of the year, because you're whittling down the accumulation portion of the fund. And then the third option, which again is often equal with that second option there, is that you, instead of taking pension payments above the minimum, is that you take partial commutations. And of course, the reason you might do that is because it can provide cap space potentially, or transfer balance cap space. And again, if you know that you're going to be receiving a pension from a spouse in the future as a reversionary pension, or potentially the death benefit income stream, or you've got the capacity to make more contributions in the future, then having a little bit of additional cap space can be of benefit. So I am of the school of thought that no one way is better than the other. Everybody's circumstances are different, and so it's a matter of working out what's the best approach for your own situation, and therefore for your client base. And even for your client base, it's going to be different for each member. But then once you've made that decision, it is a prospective decision, not a retrospective decision. So you then need to document it, right? And so you need to document, obviously, first and foremost, that the first objective is to meet the minimum pension obligation. And then what you may do as a generic piece of commentary is you may say, and then any amounts above that, we will identify at the time as to whether or not they will be a lump sum withdrawal from accumulation or a partial commutation. But it's about having a process in place and knowing that next year's rules will be different because the minimum pension goes up.
Yeah, will be increased. There is another school of thought around the order in which the payments are taken.
Yep.
And that is, if it's very clear and with a high degree of confidence, you can predict exactly what the clients are going to withdraw for the year, then potentially if you take the lump sum or the commutation at the start, it will have a better impact on the actuarial percentage or the amount of the fund that is in tax exempt pension phase for the year. However, that requires it relies on everything just playing out perfectly as planned.
Yeah.
And the actual benefit to that would be perhaps negligible.
Yeah, and I will say, and I'll chuck in the one caveat to that, is that you do that, and so I'd like my first lump sum to be from my accumulation interest, right, to reduce my exempt current pension income deduction, and then life gets in the way.
Yep.
And you don't draw the minimum pension, and so then you've unwound all
Creates
the work.
issues.
So yeah, so again, all the greatest strategic planning in the world will come undone based on the fact that stuff happens to people and circumstances change. So yeah, but again, the longer you can be in the pension environment, the better it is from a taxing point of view from the fund. So
yeah, it's just important, obviously, and this is something advisors particularly understand around the needs of the clients.
Yeah.
And making sure that those needs are being satisfied first and foremost.
Yep.
And not decisions aren't just made purely based on the tax.
Yeah, correct. So look, this slide doesn't need any introduction really. It's just a reminder that from a government point of view, and the ATO have also now put this on their website in their what's new and what's to be updated. Our minimum pension reverts to the standard requirements, and so whilst we're starting to contemplate all these rules around contributions, what we do need to do is we need to ensure that for those clients who have account-based pensions, and they were or have been paying the minimum for the last 3 years, last 4 financial years, paying the 50% reduced minimum, that they make the appropriate changes to their periodical payment as soon as practical. Now, they're going to have to do an element of guesswork for July if they're going to make an adjustment in July, because in most instances, if it's early July, they won't have a definitive account balance to be able to rely on, but they can get relatively close and make the appropriate adjustment, and then potentially draw down an additional amount to meet that minimum. But the ramifications of not drawing the minimum sort of far outweigh leaving capital in the fund if we're talking from a tax point of view, because if you fail to meet that minimum pension amount and you fail to meet it by more than 1/12, then you don't have the capacity to catch up in the next year, which in itself is only a capacity you're entitled to once anyhow. But what you end up with is a situation where you lose that exempt current pension income all the way from the beginning of the year, and that's something that people need to be mindful of. So I just put it in there as a bit of a caveat of things to be mindful of, is that now is the time to start looking at getting that periodic payment change made for the new financial year. And we touched on this a little bit earlier, and so I wanted to sort of, before we start to wrap things up and talk through more generically about a few of the things that we need to be mindful of, I wanted to touch on this transfer balance cap reporting, because you talked about it, Josh, in basically in the introduction, and I said yep, and we'll come back to that and talk about it. So now's our time to do that, because for 4 years, 5 years, 6 years, how long have we been in super reform? I think 6 years is the case. We've operated in a scenario where if your fund met certain conditions and the total super balance was less than $1 million, then for transfer balance cap purposes or transfer balance account purposes, you had annual reporting obligations. So we jumped for joy with that. That was great. It was only for those with more than $1 million that had quarterly. But with an annual comes other problems, and that is that it's not timely. And a lot of these pension conditions and a lot of things associated with pensions, like the indexation of the transfer balance cap, are linked to timely information. So we've been talking about this as an industry for a long time, is we need less total super balance thresholds. And here's the first one that's being removed, and that is that they're removing the $1 million total super balance threshold from the 1st of July, and everybody will be a quarterly reporter for all of those events other than the legislatively framed ones, such as commutations for excess transfer balance accounts and other commutation authorities where there's certain 10-day reporting obligations. But it means that we have to report everything 28 days after the end of the quarter in which it occurred. But there's also an additional piece, and that is for all of those current annual lodges, they don't have until lodgement 2024. So they don't have until the 15th of May. There's effectively a cut-off date, which is the 28th of October this year. So any of the events, if you see them there, event one, that might be something that happened last July, would normally need to be lodged in May next year when you lodge return. That must be done by the 28th of October. Then event 2 by the 28th of October. And then event 3, which is in the new financial year under the new regime, must also be reported by that same date. So it's just really a matter of getting on top of all of those matters now. But I'll add in one more bit to that, and that is that because of the personal transfer balance cap indexation piece, as I said, don't look at 28th of October. Try and get them in as close to 30th of June, if not before. So any event that's occurred up until now should have almost been reported. If there's any pension commencements, any part, particularly commutations, which will potentially impact things as well, because people will have a misrepresentation as to what their account balance is. Get all that sort of stuff reported now. So
having up to date information is, as I said, really important.
Yeah,
it's been part of what it's actually the core value of our solution is. For 20 years now, we've had at least a full reconciliation on a monthly basis. And it really, so not just to satisfy the compliance requirements, but actually having accurate information that can be relied on is really important. So if you're not getting that regular reporting and full reconciliation of financials, do make sure that you speak to someone that can help. Of course, we can.
So a couple of items, and I just wanted to touch on this one because we've talked about it a little bit, and I touched on it in our budget update for those that attended last month. But this SMSF residency issue is a key one because it's on the government's radar, and anyone that looks closely at the ATO website, then welcome to my world as well. But this week the ATO released a tax ruling about individuals and residency status. So we're starting to see the wheels being put in motion for changes around the whole concept of residency. However, we haven't yet seen legislation that will rectify the situation for self-managed super funds and the definition of a resident superannuation fund. And we're now in the middle of June. So unless we see legislation coming in the next 2 weeks and receive royal assent, I think you know where I'm coming with that, is that's very unlikely to happen because there'll be no consultation period. It means that this measure will not come in until the 1st of July following royal assent, which means not until 1 July 2024. So if you've got clients overseas and they're looking to contribute to their self-managed super fund, you've got to do the testing of the 50% of all active members and make sure you've got enough resident members contributing to offset anyone overseas, or they have to contribute elsewhere. So we've got to make sure that we understand the ramifications of that. So I thought it was an important one to highlight. Again, if we've got some clients overseas saying, we'd like to contribute to our super fund this year before 30 June, then really they need to make sure that they satisfy all of those requirements. So what I wanted to finish off with really just a number of open-ended questions, and that might lead to a few questions as well from those in attendance. So if I sort of throw these open and it might then just touch on probably the top one primarily with you, Josh, but issues like, has the pension been paid? Have we paid our minimum pension? Have we put in place the rules for excess drawdowns that I just touched on there? Have you got your notice of intention timing right from a pension commencement point of view, and your LRBA documentation? Have you thought through all of those sorts of things? But you touched on it before in the conversation piece. Has the fund obtained appropriate valuations? Because tell me if I'm wrong, but is it probably one of the things that slows down administration more than anything else is the non-standard assets?
Absolutely. So for where assets aren't, there's not a listed market or some sort of a ready way to access a valuation, it can really slow things down. Unlisted investments, property, particularly commercial property, it can be volatile and it can significantly impact the value of the assets and your total super balance, etc., your minimum pension calculation, things like that, that really rely on those valuations. And the timing of getting that valuation as close to the end of the financial year is really important. The whole topic of valuations is quite a big one, and I think we have done a webinar on it in the past around investments and the importance of valuations. And we also have a fact sheet about it. But getting that right and getting it right soon is critical to make sure that the finalisation of the financials, the tax return, the audit can occur pretty seamlessly after that.
Yeah, and I know that like all those historical webinars are available on the website, so anyone can jump in and view that market valuation one. Like with a lot of these subject matters, you've got the history of what we've presented in the past there, which is a really good offering to those that use the service. So that's a real positive. So is there any other sort of final points, Josh, that you want to raise in regards to the end of year and things that people might need to be mindful of?
Look, I think we've covered a lot, and I think on the screen we've got a good balance across the pension side of things, contributions, and the documentation that needs to be done, and a few unique ones around the LRBA changes. That's something that's got to be done proactively. There's only just under 3 weeks left now, and the last day of the year, financial year, happens to be a Friday. So making sure that any contributions that are made are done and can clear in the super fund bank account ahead of that. So don't leave it to that week. Don't leave it to that day or the day before. And similarly, make sure that the pensions that you're taking are based on actual 30th of June 2022 numbers, just to make sure that you don't fall shy of the minimum payment there as well.
And look, and that's interesting. So my last comment will be that I did notice in those ATO updates that the ATO clearinghouse will actually be offline for 2 of those 3 weeks or a certain period of time. So, no, the last week. So you really do need to get those contributions in early particularly if you know of clients that use those clearinghouse requirements. So look, if you've got any questions, please put them in the chat box. We don't have any that have come through during the session. So thank you, Josh. Again, thanks for having me here to present on behalf of SuperGuardian. I always come in and enjoy doing that. Thank you everyone for attending. Hopefully you got some benefit out of it. You will be sent the slides as part of the CPD, so that'll be issued over the next few days. And as I just alluded to, the presentation will be online also probably in the next sort of week or so.
Thanks very much for joining us, Tim. Thanks everyone for joining us. If it's your first time, we really appreciate that. Look out for the next webinar in around about a month. And have a great day.
Excellent. Cheers. Thanks, Josh.